Hi everyone, welcome back to the US individual taxation classes. This video is last in series for the Enroll Agent Part 1. Yes, here we'll be covering specialized return for individual, that is estate tax return and gift tax return. So let's dive into to understand more in detail about estate tax as well as the gift tax. And this video is last in series for Enroll Agent. If you have not watched the earlier video, I request you to please go through and watch the earlier video, and let's do it Enroll Agent together. Hi everyone, welcome to the US taxation class. Today we are starting the last chapter, fifth chapter, specialized return for individual. So in this chapter you can expect around 12 questions in your exam. So that will be coming from estate taxes, gift taxes and international information reporting. So today we'll target to cover estate tax and gift tax both, and then tomorrow we'll be finishing off international information reporting. If something split over, then maybe next Saturday we'll try to finish it off. Right. So for the ease of, like gift tax and estate tax are generally come under the, unified tax category. So what I did, rather than having like separately explanation for gift tax and separate explanation for estate tax, I put both the things in a table so that, one by one we can go step by step and both the tax laws can be easily covered in one go. Right. So that's the whole objective. So let's dive into it. Let me increase the size. Is it comfortable, visible to each one of you?
Exactly.
Yes, okay. Sir. So first we'll be looking at estate tax, and parallelly we'll be looking at the same point for the gift tax, so that you can side by side correlate and ensure like both the tax laws you are comfortable understanding. So first one is estate tax. Estate tax is imposed on the estate of descendant. Descendant means the person who is dead, right? The person who is dead rather than the beneficiary, that means who is receiving. So generally estate tax is being imposed in the hand of the executor of the will, right? So he or she will be responsible for paying the estate tax before it is handed over to the hirer. Second way, if you see the gift tax. So gift, what is gift? That means a one person giving certain gift to another person. So that is called gift. So who should be paying the gift tax? It is difficult to track the gift given to third party or gift given to any person and collect the tax from that person who is receiving the gift. So IRS made it impose on the gift taxes on the person who is giving the gift. It will be easy for the IRS to track the person who is giving the gift. So hence it is being taxable in the hand of the person who is providing the gift. Same way, like the person who is dying or who is dead is being his estate is being taxable in the hand of executor, right? And the gift is being taxable in the hand of person who is giving gift. So if you look at right hand side, transfer subject to gift tax. So gift tax is levied on the donor. Gift tax is levied on the donor. Who is donor? Who is giving the gift, right? And at what price? The fair market value of all taxable gift. We'll be understanding in detail what is fair market value and how that fair market value need to be calculated in both the categories. So there are certain exceptions to this. General rule is, exception to the present interest rule is, a transfer for the benefit of person who has not attained the age of 21 is considered a gift of present interest if all of the following conditions are satisfied. First one is, both the property and the income may be spent by or for the benefit of minor before he or she reaches 21-year age. That means the amount you are giving as a gift or the amount you are spending for the benefit is for the benefit of minor. Minor is who is less than 21 years of age. Second is any position of the property or its income not expended for the minor before reaching 21 year of age must go to the minor at 21 year of age. That means whatever the money you are spending till the time he or she is attaining the age of 21 year, it will go into his or her account directly. Third is if minor die before the age of 21, the property and its income must be payable to the minor estate or as minor directed. So it should be in the will of the minor whom he or she wants to give the property which he has received as a gift. Right? So people do, like a lot of rich people do the tax planning based on the gift tax also. Exemption. So there are certain exemption for estate tax as well as for the gift tax. So both of them like very much common because it comes under the Unified Tax Act. So the amount of $11.7 million is the lifetime exemption. That means one person in his or her entire life can avail an exemption up to $11.7 million for estate tax when the married taxpayer transfer to the surviving spouse. Are you getting it, or shall I explain more in detail? Vivek, Garima, Mayank?
Good.
So what is estate? If you can help me.
सर estate का मतलब लाइक उसमें जो भी कुछ बनाया है तो लाइक estate और gift में मेनली ये डिफरेंस हुआ ना estate tax और gift में ये सर
विरासत.
Yeah, absolutely. In very layman language you can say virasat.
estate
Right.
tax उसकी डेथ पे ही जाएगा.
Yes.
टाइम वो लाइफ टाइम में जैसे किसी को दे दिया हमने $100,000 estate tax के बाद ही ट्रांसफर होगा.
Yeah. Yeah. Garima, Vivek.
ये सर जो $11.7 million है ये exempted है amount.
We will be coming to that. First, we all understand what is estate. Estate is all the value or property that individual do have before his or her death. That is called estate. So all the property which is being transferred after the death, either to the spouse or to the legal hire, are being subject to estate tax.
Okay.
That is what estate tax is. Gift is, that means you are giving certain gift to your spouse, to your children, to your friend, or to the political party, or for any other reason. That is called gift. Right? Clear? Garima, Vivek?
तो गिफ्ट का एक आपने बताया था ना 16,000 तो वो exempt.
Yes, we are coming to that. First, conceptually, let's understand what is estate and what is gift. Now, coming to the exemption part. So, in the exemption part, for estate tax, that is once in a lifetime, is being available up to $11.7 million. Right? For example, if any individual's grandfather passed away and he has signed the will and given all his property in the name of grandson, and let's assume the total property value is $15 million. So in that $15 million, $11.7 million is exempt. Only for the remaining $3.3 million, he or she need to pay taxes. Make sense?
Yes, sir.
Yes, sir.
Yes. Right? Yes. And same way, if you look at right hand side about the gift tax. So gift tax is being exempt up to $15,000 per person per year for an individual. If the married filing jointly, they both are giving gift to an individual, so then exemption limit increased to $30,000. That means 15,000, 15,000 each.
Sir.
Yes, ma'am.
So like you are just in some previous classes, it is known that first gift is can be of not taxable and can be paid of any amount.
Sorry, say that again.
So like if someone is giving the gift for the first time, and so it is known that it is not taxable.
No, up to $15,000 it's not. But if the gift is more than $15,000, then it is taxable.
So it is not a like a first time. If you're giving a gift to someone at the first time, so it is not taxable of any amount.
No, that is for the US citizen spouse. So you can give any amount of gift to your spouse if he or she is a US citizen.
Okay.
That will be coming. But other than spouse, if you are giving the gift more than $15,000, then it is taxable over and above $15,000.
Okay. Yes.
Now look at the notes in left hand side. When married taxpayer estate transferred to surviving spouse, then no federal tax will be imposed on the death of surviving spouse. The couple wealth may be taxable in the hand of hirer later. What it means, for example, there is an husband and wife. For any reason, let's say one spouse died, and all the property of one spouse go in the hand of another spouse. At that point of time, it is not taxable. But let's assume the other spouse also die, and then entire property go in the hand of legal hirer, maybe their son, daughter, grandson, granddaughter. So in that case of scenario, it will be taxable. Make sense?
Yes.
Yes, sir.
So when there is, like, let's say Mr. X and Mrs. X, maybe I can put an example. So let's assume there's a couple, Mr. X, A, and Miss A, and they both have, let's say, property of $20 million.
So like if at the time of death or 6 months before death, and
No,
both the
we are coming to that. That is for the fair market valuation. So as of now, like we are discussing, if Mr. X and Mrs. A, if any spouse die, what will happen in that case? So for example, Mrs. A died, right? And they both have this 20 million property. So this entire property will go in the hand of Mr. A. And now, for any reason, maybe Mr. A also die after a year. And then this property goes to their son, Mr. X, right? So at that point of time, it will be taxable in the hand of Mr. As an estate of Mr. and Mrs. A. Make sense? Divya, Mayan?
Yes.
Okay. Now, second point is unified tax credit. So lifetime exemption up to $23.4 million is available for second time surviving spouse. So what does it mean? It means, let's look at same example. There is Mr. A and Mrs. A, right? And let's assume Mr. A has 20 million property and Mr. A die, right? And after this death, all the property has been transferred to Mrs. A, which is $20 million, right? And now Mrs. A, she got married with, let's say, Mr. B. And Mr. B, let's assume, have $15 million property. And unfortunately, after a year, Mr. B also died. So then she got another $15 million property. So now in total, she has received $20 million and $15 million, right? Total, she got $35 million property. So in this case of scenario, the cumulative exemption is being available to her is up to 11,71234 plus 11,71234. So up to 23.4 million, she can claim the exemption, and only for the remaining she need to pay taxes. That's what it means. Unified tax credit, lifetime exemption up to 23.4 million. That is 11.7 million for first surviving spouse and 11.7 million for second surviving spouse is available for second time surviving spouse. Make sense? Yes, no?
Yes, sir.
Huh?
Yes, sir. Yes,
Vivek,
sir.
Sachin? Okay. So next one is unlimited marital deduction is only available for the surviving spouse who is a US citizen. So if you remember like earlier example which we discussed, when married taxpayer transfer the things to the surviving spouse. So in the hand of surviving spouse, it's not taxable, right? And the unified tax credit is $23.4 million. On the other hand, for the gift tax, 15,000 per donor per year. And if married filing jointly is giving gift, then they can give up to 30,000 per donor per year. And there is one lifetime exemption here also for $11.7 million is available. And following payments are not subject to gift tax. If you are making a payment for a tuition fees, if you are making a payment for medical expenses, or if you are doing a transfer to the political organization, then up to unlimited amount you can do so. So there is no limit for gifting for tuition purpose, medical purpose, and political party donation. Right? Make sense?
ये ट्यूशन पेमेंट्स मतलब अपने लिए बच्चों के लिए कर सकते हैं किसी के
Yes,
लिए?
yes. Yeah. For anyone.
Anyone.
So if you are gifting or you are paying tuition fees for anyone, so it can be considered as a gift, and unlimited amount can be done. Same way, if you are helping someone and doing medical expenses for him or her, that also unlimited amount you can do. And if you are making a political contribution, that is also being unlimited amount you can do without paying any additional taxes. So these are not deductions. What it says, if you are giving a gift up to $15,000, then it is okay. But if you are giving gift more than $15,000, then you need to pay taxes. Right? That means you are transferring your cash to someone else or transferring your property to someone else. And that property or cash can generate future income to other person. That means you are transferring the income source to other. That is the reason behind having a gift tax. Make sense? Vivek, Sachin, Divya, Garima. Now coming to the calculation. Estate amount calculation formula. How you calculate the amount of estate which is taxable. So first is gross estate. So let's understand what is gross estate first. So gross estate include fair market value of all the property of descendant at the time of death, including cash and security, real estate, proceeds of the life insurance, annuity, any portion in the joint estate, descendant interest in community property, business interest, or any other asset. Make sense? What is the estate? Estate include all assets of the individual at the time of his or her death. That asset may be cash, security, real estate, proceeds of life insurance, annuity, joint portion of an estate, interest in business, any other assets, right? Now, the point says fair market value, right? What is fair market value? Fair market value of the property at the time of death or at the alternate valuation date. So you can consider fair market value of the property for the calculation of the gross estate is either at the time of the death or at the alternate valuation date, right? So what is alternate valuation date? Alternate valuation date is that date which is 6 months from the date of the death of descendant. That means, for example, if an individual die on, let's say, 1st July 2023, right? In that case of scenario, 31st December can be considered as an alternate day. But when you should choose the alternate day, or when you can select the alternate day, if following three conditions are met. First one is gross value of the estate must be less than the date of death. That means when you are choosing alternate day for the fair market valuation, then the fair market value of the estate must be less than from the date of death. Are you getting my point? Maybe I can draw through an example. Let's assume Mr. A died on July 1, 2023, right? And the value of estate, let's say he has $20 million, right? So alternate day is December 31st, 2023, right? On December 31st, 2023, there may be a possibility there is a estate may have value of $18 million. Alternate date is this. Now on that date, the value is either $18 million or let's say $22 million, right? So just keep this example in mind. Mr. A, he died on 1st July 2023. On that date, the value of the estate was $20 million, right? And now as an estate, you choose on 31st December as alternate day, which is 6 months from the date of the death. On that date, the value of the estate either may be $18 million or maybe $22 million. Let's assume these two examples. And let's see what it says. The gross value of estate must be less than the date of death. That means you will be choosing the alternate day only and only when your estate value is coming less than the date of death value. Make sense? Yes, no?
Yes.
So in this example, in which scenario you will be choosing the alternate day, 18 million or 22 million?
18 million.
Right? Because 18 million is less than 20 million. Right? Second point is estate tax must be estate tax must be less than the date of death. That means estate tax would be less than, if estate value is less, then estate tax will automatically less. Right? Third one is proper election of alternate valuation date. That means you need to be properly disclosed in the filing of your estate tax return whether you have chosen the original date or alternate date. And crux of the story come out if the alternate date give you the less value of the estate, then only you will be selecting the alternate date. Yes or no?
Yes, sir.
So in this scenario, if it is $18 million, then only you will be selecting this, otherwise not. There is one more twist.
बट सर हमारे को तो मालूम नहीं है कि जो प्राइस है वो अप्रिशिएट होगा या लेस होगा.
Yeah, that's a good question. Here you get 9 months from the date of death to filing the estate tax return. So due date of filing the estate tax return is 9 months. So that means you will be already crossing the 6-month path. Make sense? Huh, Vivek?
नहीं अगर जैसे वैल्यू अप्रिशिएट हो गया 9 मंथ में भी तो पहले वाली वैल्यू लेंगे 20 million.
Yes. So for example, the date of death is 1st July, right? Alternate date maximum you can take 31st December, and return filing date, due date to file will be, what will be 31st March? Right? So if the price increased on, let's say, March or December, then you will select the original price, which is 1st July price. If the price decreased, then you will choose decreased price.
Okay.
Make sense?
Yes,
And
yes.
now, for example, if you have sold on, let's say, October 31st, 2023, or let's say $19 million, $19.5 million. Then in that case of scenario, what value you should be considering? If you have sold the property on 31st of October, then what value you should be considering for filing the estate tax return?
19.5 ही होगा
Why?
क्योंकि उससे कम ही हमारे को टैक्स पे करना पड़ेगा.
Right? Why not 18?
18 तो फिर उस डेट तक तो हमने सोल्ड ही नहीं करा ना.
We have already sold, so that we do not have asset. So if the asset is being sold before the alternate date, then in that case of scenario, the date of sale will be considered as an alternate date. Make sense? Mayank, Garima,
Yes, sir.
Divya,
Yes, sir.
Shubham.
Yes, sir.
Okay. So once the taxpayer made an election of valuation date, it applies to all property. That means it should not be like for half of the property, you are taking the date of death, and for half of the property, you are taking alternate date. No. So you need to choose either the original date of death or the alternate date. And that need to be applied across the assets. Make sense?
Yes, sir.
Yes, sir.
Second point is, if the property is sold or disposed of before 6 months from the date of death, then alternate valuation date should be the date of sale or disposed of, which we have discussed in example. If you have sold on 31st October, then 31st October would be can be considered as alternate date if you have chosen for the alternate date option. When there is no estate federal tax or no generation skipping transaction tax, then taxpayer should not use alternate valuation date. So if there is no tax liability, then why should you choose any date? Right? So when there is no federal tax due or no generation skipping transaction tax due, then taxpayer should not use alternate valuation date. So what is fair market value of property?
सर ये जो second point आपने बताया ना, if the property is sold or disposed of before the 6 months from the date of death, तो death से पहले ही sale कर दिए.
No, from the date of death. This one, like the date of death is 1st July. 6 months from the date of death is 31st December, but sold on 31st October.
Okay.
So what it says, if the property is sold or disposed of before 6 months from the date of death, then alternate valuation date should be the date of sale. Is it creating any confusion, this language?
Confusion तो हो रहा है सर.
Now 1 second. If the property is sold or disposed of after, or you can say within 6 months from the date of, if the property is sold or disposed of within 6 months from the date of death. Now is it better?
Yes, better.
Huh?
Better.
Shubham, Mayank?
Yes.
This is better.
Okay. Fair market value. What is fair market value? Fair market value is a price at which a knowledgeable and willing buyer and willing seller, without any undue pressure, ready to purchase and sell the property in most common market. So what is fair market value? At which like you can purchase or sell the property in the open market without any pressure, without any undue influence. What is undue influence? Do you remember from college day? Yeah, Contract Act.
So
Mayank?
like person just searched it like the person will or judgment.
नहीं कोई अपना friend ही मिल गया तो उससे ही बोल दिया भाई इतनी value दे दो.
No.
Contract में था
Like undue influence means like pressure. Maybe like you ask at a gunpoint, or maybe
like using
like
the dominant
some
power.
political leader asks, like you have to buy at this price only.
Okay.
Right. So those things are called undue pressure. That means someone is creating pressure to make a deal at unreasonable price.
I learned in the business law the abuse of dominant power.
Yeah, right. So fair market value is actually the price at which any knowledgeable means the person who know about the market, who know about the product, who know about the service, and who is being rationally aware of the market price of that particular product, is willing to buy, and the seller also have a knowledge of the market condition and the pricing and ready to sell at a particular price without any pressure. Without undue pressure means without any pressure, ready to purchase and sell. So that amount is called fair market value. Make sense? Vivek, Sachin, Garima?
Yes, sir.
Yes, sir.
Got it? So now coming back to the fair market value of property. What is fair market value of property? What is fair market value of property?
the fair market value in which a knowledgeable person who
Mhm.
want to purchase a property and he ready to take purchase property, and a knowledgeable person who want to sell, and he is also agreed to sell a property on which price. This is a fair market
Uh,
value
Basically,
Without any pressure,
without
right?
any undue pressure.
Yes, Mayank, you are saying something.
like only the price of asset would sell for in the open market when certain conditions are met.
And which date is being considered for the fair market value of property to calculate the value of estate? Either at the date of death or alternate valuation date, right? What is alternate valuation date?
Yeah, it is 6 months from the date
6
of death.
months.
6 months from the date of
Date of
death. If you have sold the property within 6 months, then
Then
what is the alternate date?
the date on which the property is sold.
The date on which property is sold, right? When you will be choosing alternate valuation date?
मैडम
6
जी
months from the date of death.
मैं तो शुद्ध देसी
Sorry. When you will be choosing alternate valuation date?
When the gross value of the estate must be less than the date of death.
Yeah. So when the value of estate or taxes are less than the date of death, right? Then only you will be choosing alternate date. Otherwise, not required to choose the alternate date. Make sense?
So like if we are not choosing the alternative minimum date, so what we are going to use for that?
The date of death,
The date of death. Okay.
right? So now coming back to the gross estate. What is gross estate? All kind of property that individual do have at the time of the death, whether it's cash, security, real estate, proceeds of life insurance, annuity, joint estate, descendants interest, business interest, or any other asset, right? And all this gross estate need to be valued at fair market value, either on the date of death or on the alternate date, if at the alternate date value of the estate is less. Simple, right? So far so good.
Yes, sir.
Now,
में IRA भी आएगा ना?
sorry, say that again.
तो IRA भी आएगा ना ग्रोथ स्टेट के अंदर?
Yes, we'll be coming to that also. That is also part of gross estate.
Okay.
This proceeds of life insurance, annuity, we have kept a separate, so we kept it IRA and retirement plan separately. We'll be discussing that also. Right. So now coming back to the calculation. So we understood what is gross estate, right? How to calculate gross estate and at what date the value need to be considered for fair market value of gross estate. Now what all things you need to reduce from the gross estate to reach to the taxable estate amount. That first one is the funeral expenses. What is funeral expenses?
वो जो अंतिम संस्कार करते हैं उसके जो expenses.
Yes. Second is administration expenses. Third one is if there is debt of descendant. That means if he or she has any loan or liability. Then any casualty loss, any charitable contribution he has returned in his or her will, or the marital deduction. Marital deduction, that means if any estate is going to the spouse, that is completely exempt. So remaining balance is taxable estate. Then you'll be adding post 1976 taxable gift if there are any. then total post 1976 transfer multiply by unified tax rate, that is 40%. So estate and gift, they both are taxable at 40% tax rate, right? So then you reach to the unified tax on the total value minus unified tax if you have already paid. Then you reach to the value of tentative estate tax minus if there is any tax credit or any other credit which you have already paid. The remaining will be estate tax payable. So very simple, gross estate minus the deductions. Deductions are very common and very self-explanatory given to you, right? And normally in exams or normally in the practice question, I have not seen is this 1976 gift or any transferable. These all are like kind of old concept, probably are not relevant for your exam, but it's there in your books. So that's the reason we have kept it over here. But normally your gross estate minus all this deduction, that is your taxable estate, multiply by 40%, that is your tax payable, minus if you have already paid any taxes or you have any tax credit, then it will be remaining estate tax payable. So that is something you need to pay. Make sense? Yes, no,
Yes.
right? On the other hand, if you see in the right hand side, gift tax calculation formula, that is also very similar. Gross gift for the current period. That means total amount of gift you have given, but that you need to categorize individual by individual. Minus deduction of the individual donee or lifetime exclusion, which is $15,000 per donee per year. And there would be one lifetime exclusion of $11.7 million. So once you reduce that, it will result into a taxable gift for the current period. Then you'll be adding the taxable gift from prior period, like future interest. In the previous year, you have given the gift, but that has value in the current year. Then you'll be adding that. Then it will give you the total taxable gift by the donor. And again, unified tax rate is 40%. So if you multiply by 40%, the gift tax on total gift will come. Then minus if we have gift tax computed on prior gift using unified tax rate, if there is any earlier year credit or minus any applicable credit, that will result into tax due on the gift for the current period. So this will be the calculation of gift tax. But both the cases, the tax rate is same. What is the tax rate?
40%.
40%, right? So this is one of the highest, you can say, tax rate. But at the same time, if you see, the exemption is also great. $11.7 million is really a handsome amount.
The receiver will be taxed or the donor?
That you need to answer. Very first topic which we have discussed. Like
Well,
in case of estate, the person who is the executor of estate need to fulfill all this formality and pay the taxes. In case of gift, the person who is giving the gift, the donor, has to pay taxes.
okay.
Right? Mayank, Garima, Shubham.
I have one question like ये जो हमने पढ़ा है gift tax calculation, इसके अंदर सर like consider like I am single, तो जैसे gift tax के लिए हमारी जो exclusion है वो $15,000 है per year का, तो जो में लिखा हुआ deductions individual donee, तो सर जैसे हम A B C को एक को 2,000, एक को 3,000, एक को 5,000, 5 + 3 + 8 10,000 दे रहे हैं, तो तीनों का आ जाएगा है ना सर?
Yes. For example, if Shubham is giving gift to Kamal, Vivek, Mayank, and Sachin, so you can give $15,000 to each four of us.
जैसे सर मैं ये मान के चलो 20 साल तक करता हूँ लगातार, तो मैं गिफ्ट दे सकता हूँ unless I reach the $11.7 million. Yeah?
Yes.
Okay.
Cumulative limit is 11.7.
Okay.
Then another point is gift split. So when you are giving, both husband and wife are giving gift, you both can give gift up to $30,000 to an individual. But at the same time, it has to be claimed on your individual tax return. So you need to split that gift to your respective individual tax return. Joint return of a gift is not permissible. So gift tax return is always individual tax return. However, spouse can split the gift amount and avail individual annual exclusion of 15,000 each. For example, if Shubham and Divya, they have given a $30,000 gift to, let's say, Vivek, right? So the $30,000 is exempt when you are giving gift, but at the same time, you need to claim in your individual tax return 15,000 Divya, 15,000 Shubham. That is called gift splitting. Make sense?
उसके लिए सर इंडिविजुअल रिटर्न भरनी पड़ेगी.
Gift tax is always be an individual return. Estate tax is always be an individual return. So these are separate return than income tax return. So if you remember in 1040, we have not seen any estate tax or gift tax. These all are separate returns. Right? Mayank, Garima, Sachin.
Yes.
Okay, sir. Okay.
These are separate return. In India also, these all are separate return because it's a separate tax law. But as we are studying individual taxation, so these tax law impact to the individual. That's the reason it's been covered in this exam. Make sense? What is the due date for filing the individual income tax return? 15th April, right? And what is the due date of filing estate tax return?
31st December.
15th April.
9 months from the date of death,
Okay, sir.
right? So because it's a different tax law. Make sense?
ये जो सर अलग से रिटर्न भरनी पड़ेगी, ये जो आप बता रहे हो, वो उसके जॉइंट रिटर्न के साथ में जाएगी कोई और?
Separate tax return. That's what I am saying. For individual tax return filing, form is 1040.
पर उसमें
Right?
तो नुकसान होगा फिर.
That need to be filed by 15th of April next year. But whereas estate tax return is a separate independent tax return, the form number is 706.
Okay.
And when that return need to be filed? 9 months from the date of death. When we need to file estate tax return? When we need to file estate tax return?
9 months after the death.
9 months from the date of death. So if somebody is die in the month of March, then his or her tax return need to be filed in the month of December. Right? It's not necessary to be April. Make sense?
और पर गिफ्ट के केस में तो सर उसमें ये नहीं होगा, नुकसान नहीं होगा, क्योंकि जॉइंट रिटर्न तो भर ही नहीं सकते.
No, in case of gift, the return filing date is same, 15th April. We are coming to that. We are coming to that. Few more points. Let's cover up them. Jointly held property. When husband and wife, they jointly hold any property. Let's say husband and wife, they both have purchased a home where they both are staying together, right? So that's registry is on joint name for the husband and wife. So in that case, like for example, like one spouse died, the other spouse already have his or her 50% share. So estate should consider only remaining 50% of the person who died, not the entire property. Make sense? If, for example, husband and wife, they have purchased a house for, let's say, $500,000 together, and that registry is in the name of both husband and wife. And now let's assume husband died. In that case of scenario, estate would be $500,000 or $250,000.
$250,000.
Right? Because for $250,000, she has already paid and it's her property. Right? The estate which is getting transferred is only remaining 50%. But let's say after a year, the other spouse also die, and now the entire property goes in the hand of son as an estate. So in that case of scenario, entire 500 would be taxable. Make sense?
Yes.
sir.
Next point is IRA. What is IRA?
Individual retirement accounts.
What is IRA?
It's an individual retirement account.
Individual retirement account and retirement plans. So here, total amount of IRA and retirement plan. For example, I have registered, for example, an individual has registered himself into the IRA. What are the three categories of IRA?
Deductible, non-deductible,
Or Roth, right? Traditional deductible IRA, traditional non-deductible IRA, and Roth IRA. Let's assume an individual has registered himself to the Roth IRA, and from last 10 years, he is paying the money for the retirement benefit plan into the IRA. Now, after 10 years, that individual died, right? So then the IRA would be transferred in the hand of other spouse or maybe legal hirer. In that case of scenario, the amount which is being transferred from the IRA or retirement plan would be considered as an taxable under the estate tax. But later on, when the individual who is receiving that IRA amount or who is receiving that retirement benefit plan, in future, if he or she is getting interest or dividend or any distribution, that interest, dividend or distribution would be considered as ordinary income and would be taxable under the Income Tax Act. Make sense? Sachin, Shubham, Garima,
Yes, sir.
Vivek. So maybe let me draw an example. For example, Mr. A was having, let's say, $100,000. So let's say he is investing $10,000 each year into the IRA. So now he has IRA of $100,000, right? And now he died. He died on when? 1st July, right? And now all his property went into the hand of Mr. X, let's assume his son, right? In the hand of son, this $100,000 would be taxable as estate tax, right? And this $100,000 will give 10% return each year, right? This they give interest income. So then this 10,000 would be considered as taxable income. Make sense? Does this make sense? Vivek, Sachin, Mayank,
Yes, sir.
any doubt?
तो सर जैसे ये रोक में हमने कहने का मतलब पहले टैक्सेस दिए हैं, बाद में हमारी इनकम टैक्सेबल नहीं होती, तो सर ये एस्टेट टैक्स तो जनरली हम ये कह सकते हैं ना ट्रस्टी टू ट्रस्टी ट्रांसफर हो गया.
Say that again. I didn't understand your question.
सर जैसे रोथ आई है के अंदर at the beginning taxable होता है, तो हम ये like
Yes, because when you are contributing to the Roth IRA, it is generally a non-deductible.
नॉन डिडक्टिव. तो सर एट द
Right.
टाइम ऑफ डिस्ट्रीब्यूशन हम ये कहते हैं ना कि इनकम इसके नॉन टैक्सेबल होगी. तो
Yes.
जैसे नॉन टैक्सेबल होगी और जो मान के मिस्टर ए हमारा एक्सपायर हो गया, तो मिस्टर एक्सपायर हो गया, लेकिन जो उसका डिसीडेंट है, जो उसका जिसने इनहेरिट करा है, उसकी ठीक हो तो सर वो लाइक अब वो उसके ऊपर टैक्सेस देगा कहने का मतलब।
So let's for example, if you have purchased a home, let's say an individual, Mr. X, has purchased a home and every year he's paying $10,000 EMI, right? And after 10 years he built a house which has value of $100,000. Now he got die. So this $100,000 worth property would be considered as estate.
Yes.
Same way, the IRA or retirement plan which he has contributed throughout his life would be considered as estate in the hand of hirer. And if the total estate value after all the deduction is coming greater than $11.7 million, then that individual need to pay estate tax. And now from that estate, if you are generating any income, for example, if you have got a house and you are generating a rental income, so that rental income would be considered as your ordinary income and would be taxable as an normal income tax rate. Same way, if you are generating the income from the retirement plans, that will also be considered as ordinary income and taxable at the normal tax rate.
Okay.
Because you have not done anything, you have received it. Make sense?
Yes, sir.
Mayank, Vivek,
Yes.
Sachin, Garima.
Yes, sir.
So if you see in the IRA and retirement plan box, total amount of IRA and retirement plan which you receive, that is subject to estate tax. And in future, the distribution income which you are receiving is subject to ordinary income tax. Now coming to the tax basis of property which you have received as estate or as gift. So you have received, let's say, the house as an estate. So what will be the value of that house in your hand? That you need to evaluate. Fair market value of the property at the date of death or alternate valuation date as elected by the taxpayer. So that will be considered as the base value. Why that will be considered as a base value? Because on that amount they have paid estate taxes, right? So if you remember here, the state taxes, for the state taxes purpose, they have calculated the fair market value of property on the date of death or at the alternate date. What is alternate date?
6 months.
6 months from the
Date of death.
date of death. And if you have sold before that, then if you have sold before that, then
At the date of selling.
So when you choose alternate date,
When the value is less than the fair market value on the date of death.
yeah, absolutely right. So same formula will apply here also. Tax basis would be considered as the fair market value. Fair market value on the date of death, or if you have chosen alternate value date. So whatever you have elected, accordingly, the same fair market value would be considered as a tax basis for the individual who is receiving the asset. Right? Make sense?
Yes.
And on the gift side, tax basis of the property in the hand of receiver would be lower of fair market value or donor basis. What is donor basis?